This variant is a cause for concern, not a cause for panic.
I definitely think that this threat is something that we have not seen before.
We have very high level of confidence that we will have it ready within 100 days.
This is Bloomberg Surveillance, Early Edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. Concern, not panic. President Biden urges Americans not to overreact to the new variant. The Moderna CEO says the Omicron variant may elude the current vaccines. Stefan Bankel's comments spark a risk-off mood in markets. And stay with Bloomberg Surveillance Early Edition. This hour, we're going to be speaking to Microsoft EMEA President Ralph Haupter and the European Commissioner for the Economy, Paolo Gentiloni. Send in your questions on IB plus TV Go. Well, so far, it is shaping up to be an ugly day. We might have had some sense of relief yesterday after Powell acted as a soothant to markets, saying that we might need to be concerned about both inflation and the economic and the employment picture with the new variant. But that wasn't enough to hold through to today. We had some lines crossing just before 6 a.m. UK time from the Moderna CEO talking about the concern of whether the vaccine will be effective. European stock 600 selling off 1.4%. One of the worst performing sectors. No surprise here. Travel and leisure down almost 2%. It is flights unable to go. It is more restrictions. It's these sorts of reopening trades that are no longer being put on if this is a variant that will start to restrict mobility once again. All the other asset moves we're seeing follow in line with that. A very classic risk-off kind of day when you have buying coming into the 10-year. You have 10-year yields lower by about 6 basis points. Now, you will also be very hard-pressed to find any region in Europe that's moving higher, and indeed anything that's moving less than 1%. UK, CAC 40, IBEX, DAX, FTSE MIB, all of them moving down by more than 1%. It's not just travel and leisure, it's every sector, and it's especially things like energy as we look at oil also selling off in this instance as well. So as the new Omicron variant spreads and travel restrictions around the world, they continue to expand. The U.S. has imposed travel curbs on some nations in southern Africa. However, President Biden says the new mutation won't prompt additional restrictions within the country.
I'll be putting forward a detailed strategy outlining how we're going to fight COVID this winter, not with shutdowns or lockdowns, but with more widespread vaccinations, boosters, testing, and more.
Now, over at the Fed, Chair Jerome Powell says Omicron poses risks to both sides of the central bank's mandate to achieve stable prices and maximum employment. It comes as he prepares to testify to the Senate Banking Committee later today. Let's dig into this. I'm joined now by Silvia Merler, Head of Policy Research and ESG at Algebris, and Bloomberg's Lynn Thomason, Managing Director of EMEA Markets. Thank you both for joining this morning. Lynn, I want to start with you and your initial take on this reaction we saw this morning for every single risk asset essentially to sell off.
Yeah, absolutely. I think, there was a thought yesterday that perhaps it was overblown, that things would be okay. Lots of press around the idea that the virus would be mild. But I think the Moderna CEO interview has clearly gotten everyone spooked again, and everything is risk off in markets.
Silvia, does this sell-off make sense to you, especially considering that the lines we got from the Moderna CEO this morning? It's not necessarily a new concern coming into the fore that the vaccines might not be effective.
Absolutely. Entirely agree with Lynn there. So I think basically yesterday evening, everybody was reassured by the comments of Pfizer CEO saying they are working under the assumption that a modification to the vaccine might be needed and they will be able to deploy within 100 days. The comments from Moderna CEO this morning were definitely not well received. And the truth is it's simply too early to know. We know that we'll have to wait about 2 weeks to really know whether this spreads faster, whether this is actually resistant to vaccines, and whether this is or is not a milder version of the virus that we have known so far. So it's really too early to say.
Silvia, does that mean if it's too early to say we should think about buying the dip and whether that's a logical move at this point?
I think it's really difficult. It's really difficult to say right now because we have so little information on this new strain that it's very difficult to make prediction on this.
Fair enough. Lynn, I want to bring you into this as well. I mean, buying the dip, it has been a very successful strategy. I mean, not just over the past few months, but for the past few years.
Oh, absolutely. It's worked every single time. And I mean, but I think now you're somewhat in a different situation where end of the year, you know, fund managers are looking at, you know, how things are going to shape up. Markets are already up 20% this year. It's not a hard decision to say, hey, let's, you know, pull back on some risk. Everything's gone up so much.
Yeah, fair enough. I mean, a lot of things to weigh up. And Silvia, of course, one of those things to weigh up is what all of this means for inflation. How do you look at the potential inflationary or disinflationary effect of a new variant that spreads more quickly coming into the population?
Well, that will depend on the combined effect of the different factors that we know are at play here, whether the variant spreads faster, whether it's more severe, and whether it can actually get around vaccines. If that's the case, then we might have obviously a negative effect of economic activity of a similar kind as we have seen in the past few years, and that may have a disinflationary effect, especially on energy, which has been driving inflation so far. On the other end, if that's not the case, we might have a less prolonged negative economic impact, but at the same time, inflation might not be affected.
Yeah, Lynn, I mean, this is something that... Sorry, go ahead, Silvia.
Sorry.
Go ahead.
It might actually be affected on the opposite end, meaning if this is restricting movement, if people feel less confident in going back to work, this might actually have a positive impact on wages and costs.
And I also just want to bring to our viewers' attention as well a line crossing the terminal now that benchmark European gas prices have climbed above 100 megawatts per hour in terms of euro pricing. That's, of course, on the ICE exchange. I mean, this is another thing, Lynn, we have to worry about as well. Energy prices. I mean, it is really cold outside of this building here in London today.
Yeah, exactly. And I mean, you know, the coronavirus isn't going to solve, you know, that issue. And it's clearly a big issue for the European economy and for British consumers, how much more money they're going to have to spend in heating bills and dealing with, you know, gas suppliers that are having a hard time making it these days.
Right, as if there weren't enough risks to worry about at this moment. Silvia, I want to bring you into the energy conversation as well. Clearly, this isn't going away anytime soon. How do you navigate this space at the moment? In terms of what investments look attractive, do you stay away from this market? How are you approaching energy right now?
So I think one of the issues that is a bit overlooked on the energy side is we're seeing this as a very transitory factor right now because it's popped up all of a sudden. But if you think about the longer term trends, this is something that might as well remain structurally with us, also due to the energy transition that we have embarked on. We have done some research on this very recently, actually. We have tried to estimate how the consumer price index would have been impacted if we had included in the index also the cost of our growing emissions that we will have to pay and that will become increasingly more transparent and explicit as a price, no longer as a shadow price going forward. And what we find is that we would have had a higher inflation rate of about 1% per year. So it's actually not negligible in terms of effect, if you think the most central banks' target is 2% per year. So this is very well something that might remain with us, not just be a blip linked to the special situation that we're currently in due to pandemic on one side and geopolitics on the other side.
Silvia, thanks so much for joining this morning. That's Silvia Merler from Algebris. You're going to stick around with us, and Lynn Thomason from Bloomberg. Thanks for joining as well. Now, Smart Conversations are going to continue on Bloomberg Surveillance Early Edition. Later on the program, we're going to be speaking to Microsoft EMEA President Ralph Haupter and to the European Commissioner for the Economy, Paolo Gentiloni. Send in your questions. That's on IB plus TV Go. This is Bloomberg.
I can't speculate on that. I think the piece of it that we control, we've said, Stéphane Bancel, the CEO, said, we think we're in a position to do, based on the 10 years of platform development we've done already with mRNA and mRNA vaccines, I think we're in an ideal position to respond within the kind of 60-day time frame.
Moderna's founder and chairman there telling Bloomberg that while Omicron does pose a serious threat, he's hopeful that a new vaccine targeted at the variant can be produced in the next 2 months. Now, all of this comes as the company's CEO warns that a large number of mutations on Omicron spike protein mean it will likely be able to evade protection provided by existing vaccines. President Biden has also urged the U.S. public to get booster shots, and the UK government has widened access to third shots to all adults. Well, Silvia Merler from Algebris is still with us this morning. So, Silvia, we were talking a little bit about perhaps the inflationary or disinflationary impact of this. Earlier today, De Guindos, the ECB vice president, was talking about how supply chain bottlenecks may last longer than expected. There's a risk that inflation will not go down as quickly and as much as we predicted. Considering the various sorts of different things at play for the ECB, do they have to sit on their hands and wait even longer than perhaps they were going to already?
The $1 million question, that's for sure, even for them at the ECB. Well, I think if you look at the dynamics that are at play behind the inflation that we're seeing now, all the things that were pointing towards transitory are fading or have faded away. So supply bottlenecks, yes, we all assume this was a temporary one-off things related to the reopening post-COVID. But especially if you look at Europe, there are reasons to believe that this may become structural going forward. There may be some re-onshoring of productions that are now very clearly strategic from the European Union's standpoint. And if you look at the European Union's industrial policy strategy, it's all about making sure that Europe can be safe in the face of potential disruptions like COVID, but also geopolitical disruptions going forward. So it's a lot about industrial policy, about developing productions that so far had been offshore, then this may increase costs. So it may mean the kind of inflation that we're seeing now may be here to stay for a bit longer than we expected. If you look at countries' dynamics, obviously German inflation surprised on the upside, French inflation also a little bit, Spain and Belgium also on the same kind of track. Take Germany. Germany is the largest economy in the Eurozone. The new German government already said that they plan to increase minimum wage. That's going to affect around 10 million people. So obviously the direction of travel seems to be pretty clear there.
So does that mean that the policy error potentially from the ECB is not reacting to that direction of travel of inflation?
Well, I'd say the ECB has a long history of missing its inflation target on the downside. In this respect, I think there's a little bit more safe room in terms of error than the Federal Reserve might have, where also the dynamics in inflation has been a lot faster and a lot more prominent also in earlier months. And the dynamics on the labor markets are actually very different. If you look at the labor market in the US, you can still see very significant frictions if you do a beverage curve analysis. In Europe, that's not the case so much because the market functions in a different way. So that part of the problem seems to be less relevant for the European Central Bank, which is probably reassuring for them. Of course, there are a number of long-term factors that are really difficult to predict at this point in time because we don't really know what the extent of that will be. Energy is one of them, perhaps the easiest one to predict, but all this potential structural re-onshoring, reshaping of the European economy going forward is open-ended.
It's open-ended, but I do wonder, as Marcus Ashworth from Bloomberg Opinion points out, that COVID, the Omicron variant, acts as a get-out-of-jail-free card. Does this allow the ECB more time, and likewise the Fed? And quickly here, Silvia.
I think so. I mean, the ECB, I think, has played this communication game not as well as it might have, but it seems to be a problem that's common across central banks. I mean, you mentioned Fed Chairman Powell's remarks of yesterday evening. Those were also pointing in both directions, saying really the effect of this shock that we're going through right now might be. It's really unclear on what part of the central bank's mandate that's going to impact first and most importantly. So it seems to be a communication problem that everybody is sharing at this point in time.
Right. Silvia, really fantastic to have you on this morning. That's Silvia Merler, Head of Policy Research and ESG at Algebris. Now, let's get over to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Danny. Fed Chair Jay Powell says the Omicron variant poses a risk to both sides of his mandate to achieve stable prices and maximum employment. In a prepared testimony ahead of a Senate appearance, Powell says the virus could reduce people's willingness to work in person, slowing progress in the labor market and intensifying supply chain disruptions. He goes before the Senate Banking Committee at 3 p.m. UK time today. Now, Sweden's first female Prime Minister has been re-elected after narrowly winning a vote in Parliament. Social Democrat Magdalena Andersson will form a one-party government, easing political turmoil prompted by her resignation last week. Andersson stepped down as Prime Minister just hours after being appointed when her junior partner in government quit following a budget defeat in Parliament. The EU's chief nuclear envoy says talks to revive the 2015 Iran nuclear deal have begun positively, with Tehran showing it's ready to engage in serious work over the coming weeks. Success in Vienna could lift sanctions from Iran's economy, but US officials are said to be increasingly pessimistic over the chances of a deal with Iran's new hardline government. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thanks so much. Now, coming up, we're going to be talking Twitter following co-founder Jack Dorsey tweeting, of course, his resignation as CEO effective immediately. This is Bloomberg. Concern, not panic. President Biden urges Americans not to overreact to the new variant. The Moderna CEO says the Omicron variant may elude the current vaccine. Stéphane Basel's comments spark a risk-off mood in markets. And stay with Bloomberg Surveillance Early Edition. Coming up, we're going to be speaking to the European Commissioner for the Economy, Paolo Gentiloni. And up in just a few minutes, Microsoft EMEA President. Send in your questions on IB plus TV Go. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get a check on markets, which have been decidedly ugly after a somewhat of a rebound yesterday. But it's clear that these nerves are very present in markets. We're looking at a Europe stock 600 that's selling off 1.5%. Leading those losses are travel and leisure. The concern is the effectiveness of the vaccine against the new Omicron variant. But it's really all of the risky type assets which are selling off. Our producer Isaac Munoz pointing out that the Turkish lira is now weakening past 13 per dollar. So again, just another one of these instances where these very risky type assets, the high beta ones, underperforming. To the upside, you have some of the safe haven plays. You have a 10-year yield that's moving lower by more than 6 basis points. You also have a yen, a big bid to the yen today, which is up about 0.7%. So there is your Turkish lira, the dollar versus the lira, again, setting new highs, that pair, as the concerns, especially over emerging markets. All right, well, let's shift gears a little bit and talk tech. Vying with Apple for the title of the world's most valuable company, Microsoft remains focused on the future, especially the future of work in a post-pandemic world. The software giant has been working on an employee experience platform as well as a wider metaverse offering in order to address the changing landscape in our workplaces and social spaces. executives. We're joined now by Microsoft's EMEA President Ralph Haupter. Ralph, thanks so much for joining us this morning. So I know you recently put out the 2021 Work Trend Index, and in it you point to this great reshuffle in terms of employees, where they want to work, whether they're leaving. We know about it anecdotally, but just how much of a regime and perhaps reckoning is this?
No, thanks for having me. I think we did the study and we have been pretty astonished on seeing what the trends are coming forward. And there are two things, as you mentioned. One is actually a hybrid paradox, what I would call it, and the other one a great shuffle in what people think they want to do in the future. The data would tell you the following. 9 to 5 is obviously gone, and still companies look for productivity where people look for the most flexibility. And then you look at the hybrid paradox. When you ask the question, where do you want to work in the future? More than 70% say, I want to have the flexibility and work from home. At the same time, 67% say, I want to find a way to connect very well and very close with my teammates and my colleagues. And that's a paradox in itself, as you understand. Now, the other data, which I almost would say is more concerning or alarming for us as leaders to be great and help teams to understand where to go, is this great reshuffle. 40% of employees tell us and say, hey, I may change job, I may change company going forward because I have experienced a different environment. And so I want to acknowledge that one and just adjust my lifestyle and my working style.
Yeah, I mean, it's really interesting, especially when it comes into how you use tech for that. If you want employees who want to be more present, more connected, but then they're also leaving because of burnout, where is the balance between the two?
It's actually a great question. It's one of the questions I get most asked from leaders these days. And say, help me understand, how do I keep culture? How do I keep connectivity? How do I keep this hybrid work? And how do I give people employment experiences, work experiences? So one of the big things I would say we really need to acknowledge is that the future of the work environment is a digital environment. And so how do companies and help invest in that one? Let me give you an example. Unilever with us went on this journey, and they basically looked at employees' experience on well-being, where they train people, how they actually collaborate, which spaces they use. And they use a platform, which is a pure digital platform, which helps employees and companies to understand and connect. It's Viva. It's the new kind of way we have on giving people a real platform to communicate and collaborate together. And that makes a huge difference. For Unilever, they just figured out how to people help them being better in their businesses, but adapt their personal lifestyle to the really demand of the company, which makes a huge difference. And that's what we go seeing forward. This digital experience versus a physical workspace is huge.
How do you, though, prevent, again, this burnout question? Because when you're very connected, and we've seen this in the work from home environment, that everyone always complains, I can't turn off. I'm always answering emails. I'm always there. I don't have that time to kind of move away. When you are offering technology that allows this deep connection, how do you make sure that employees aren't always connected?
Actually, a great question. I think one of that one is the opportunity to first time understand your personal kind of lifestyle and your personal usage of technology. For me, myself, I'm using data, how I work and with whom I'm collaborating. So I'm getting supported by AI and by the system to whom I should reach out to keep connection, but also when I need to have time, downtime, focus time. And so my schedule is, the third, I would say, managed by giving me guidance on where I should take focus time to take care for myself, even time to take sport or other activities to just be blended out of the real 24/7 online experience. So that capability and that support is super important in addressing a big challenge, which well-being is for sure.
Ralph, we also saw Portugal recently banning bosses from emailing their staff out of hours. To what degree are you expecting new regulations to come in, perhaps regardless of where the tech goes?
I think regulation is not really an option to help us get smart as a society. I think tech is a great place and functionality in tech is supporting you very well. So when you send today kind of communication, you get actually in the mail acknowledged that people you're addressing around the globe may not be in their working zone, in their working time. So there is capability of technology and products available to help that one. I laughed at the fact the government is calling out the challenge is fantastic. I think the regulatory approach is better supported by using technology in what we have today. You can today decide and use these capabilities that you don't send emails where somebody else is actually in the very well-deserved weekend. So then that's possible through tech already.
Ralph, How does the metaverse fit into all of this?
Fantastically. I was excited seeing you in the spin on the metaverse showing. For us, that's next. We did offices collaboration. I think we all went through the journey of having video conferences like that in great quality and context. But the metaverse is the next big chapter, which I think is giving us a real capability to go augmented. We see that already in manufacturing a lot, where you have production sites being augmented on HoloLens capabilities, so remote services, that is already in place. But the real metaverse, where you actually combine physical and digital world, is a fantastic experience to come. Please be excited. It's coming soon, it's coming fast, and it's coming for all of us on our own choices and terms, but you really will be able to have digital and the physical world coming together as an experience.
Ralph, I know that this is a significant investment from Microsoft, and along those same lines, analysts often talk about the cash richness, if I can invent a new word, the high operating cash flow for Microsoft, about $131 billion sitting on the balance sheet. What does a Microsoft with that significant firepower look like and do?
I think we are focused very much on building platforms and having a rich portfolio which is helping our customers. With these platforms, as you have seen, we are investing in being very different and capable to help companies in their industries and meet them in their industries with extended technology. This is where our invest is going. You saw us announcing platforms for manufacturing, for finance, for healthcare, and just recently we did a platform for sustainability. And these are the investments which we think are core and where we use our energy and, yes, our money.
Ralph, before I let you go, I do want to bring up some news that hit the wire over the weekend. Your boss, Mr. Nadella, selling about half of his own shares of Microsoft. Now, I know that this does often happen for personal reasons, but I did want to bring it up because strategists, including Matt Maley over at Talbacken, said that it's an important sign that Mr. Nadella thinks the stock won't go up from here and that perhaps it's moved too far of its fundamentals. What would you say to shareholders that perhaps share a similar concern?
I can't comment that one. I know that Satya has been public on personal investments where we actually invested, I think, even in schools and institutions we all feel very proud about. And we all feel very, very, very proud about what Satya is doing for us working within Microsoft, but also on the way how he's looking at global needs of how technology can be used and which impact technology has on society. We feel proud about everything what he's doing for us and for the world, and so I leave it there.
All right, Ralph, we'll have to leave it there as well. Unfortunately, we're out of time. Really great to have you on with us this morning. That's Microsoft's EMEA President Ralph Haupter. Thanks again for joining us. Now, coming up, Europe's inflation spike. We're going to speak exclusively to the European Commissioner for the Economy, Paolo Gentiloni. That's next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now let's turn to the inflation picture in Europe. Germany and Spain have registered price increases not seen since 1992. Meanwhile, we got numbers from France earlier this morning with CPI hitting the highest rate in over a decade. That's adding pressure on governments and the ECB to back up the case that inflationary pressures are temporary. Our European correspondent, Maria Tadeo, is in Brussels now with a guest. Maria?
Yes, Danny, we're here to debrief everything you mentioned, inflation, economic growth, with the Economic Commissioner, Paolo Gentiloni. Good morning. Thank you for being here. It's always nice to see you. You know, I have to ask you today, we're seeing markets again back in a panic because of this new mutation, this new pandemic kind of, kicking in again. What are the prospects for growth? It does seem that the situation right now, it's very cloudy.
Well, it's very uncertain, I would say. Of course, recovery is there. And all the figures that we have, also recently confirmed by, for example, this morning, France and Italy for the third quarter, are confirming that there is a strong recovery, that demand is pushing the recovery. At the same time, we know the risks that were already there, inflation, bottlenecks, but we have a new risk, which is this new variant. And so I think uncertainty and volatility are linked also to this new variant. My guess, my advice is to consider the fact that our economies are adapted to these crises. We have plenty of vaccines in our countries. Of course, we have to extend vaccination all over the world, but there is no reason for panic.
So your message is actually very similar to President Biden yesterday, who said we shouldn't worry or should not panic because the fundamentals of the economy are actually still very strong.
Yes, I think indeed this is the situation. We are already in a relatively small wave of pandemic. It's the Delta pandemic, not the Omicron pandemic at the moment. And we see index of restrictions and index of mobility changing since more than 1 month. Restriction is increasing and mobility is reducing. But this is not at the same path of previous lockdowns, and the economic consequence of these restrictions are weaker than in previous crises because of the fact that the economy is completely adapted. I'm not saying that we will not face problems, especially on travel industries, on tourism, possibly we can have new problems. But overall, I think our economies are adapted to this kind of crisis because of vaccines.
But what happens if a country like Germany goes into a lockdown? You know, there's many out there who say if that happens, then you're going to see a leg lower for everything. You know, stocks, and you're going to see this panic again kind of kick in. You know, this is a repetition of another winter lockdown.
Well, I think the conditions now are for taking some restrictive measures. And they are, I think, fully justified because of this uncertainty connected to the Omicron variant. But I don't see now conditions for total and full lockdowns comparable to the one we lived previously.
And when it comes to inflation, of course, it's a huge conversation, I guess, for the ECB now. It's very difficult to deal with this, but it also affects your portfolio. You know, we're seeing prices are jumping big time. This is hitting consumers now and the pocket. You know, that's where it hurts. So when are we going to see this perhaps on a more sustainable basis? Is there a horizon that you're willing to stick with?
Well, in our forecast that we presented in November, beginning of this month, the idea was of inflation continue to on the rise during winter, during these months, November, December, probably January. We will see. But the driver of inflation begin to fade next year. Probably at the end of the winter. And so I think the ECB point saying there are no reason now to tighten our monetary policy are fully justified.
And can I ask you, you know, when you're looking at this, there's also a big debate as to whether or not the PEP program is going to end, as to whether the fiscal rules in Europe, I mean, you're very involved in that, are going to go back. Germany is talking about the debt break in 2023. A lot of people say this is completely crazy. You know, the fact that we're having this conversation with an economy that's still healing, with all of this uncertainty, why are we still talking about this?
I think it's not reasonable to have in the same page uncertainty, concern about new variants and the consequences of this situation, and a message of tighten fiscal policy, move monetary policy in wrong directions. This is not for now. Now I think there is reason to keep a supportive fiscal stance.
So you think it still needs more stimulus? Like this is an economy that needs more stimulus?
A more selective support, not universal. But we are still there. We are still fighting to give this recovery full speed. And I think it would be completely wrong now to tighten this situation.
And just as a final question, you know, there's still also this debate about the 3% debt to GDP, the 60%. Many out there say, given the amount of debt that we've seen with this pandemic, you know, these numbers don't actually mean anything. It's not even a gauge for risk perception anymore. Why are we so fixated on those two measures? Should they change?
Well, I think that European countries will go towards this 3% of deficit threshold quite quickly in a couple of years. Different is, of course, the debate about the debt. But I think also without changing these thresholds, because as you know, these thresholds are in our treaties, and changing them is not easy, and it is not our purpose. But we can change the path of the reduction of the debt to make it more realistic. If we keep a path of reduction of debt that it's completely unrealistic, I don't think we will strengthen the European institutions and the European economy.
And just as a very final question, I have to ask you, you're Italian, you know there's so much speculation as to what happens in Italy next year. Are you open perhaps to returning to Italy in some capacity? I'm sure you know which job I'm alluding to, but...
I'm here and fully committed to address the issues we were speaking about.
Well, Commissioner Paolo Gentiloni, thank you so much. Commissario, thank you so much. Always good to see you.
Thank you.
Danny?
Maria, thanks so much. And Maria, I want you to stick there for just a moment because I want to bring us some lines crossing over Europe and vaccination, get your take on it. The Greek Prime Minister announcing that those above 60 years old who aren't vaccinated are to face a fine. Of course, Germany already restricting those who are unvaccinated. Maria, how do we see these types of restrictions, these types of sticks when it comes to vaccines shaping up in Europe at the moment?
Well, Danny, if I understand it correctly, of course, I didn't see the headlines, but the idea is that the Greek government will now put a fine to people over the age of 60 who don't want to get the vaccine. You know, I think a lot of this really does reflect the fact that some of the incentives up until now have not really worked on the positive basis, but also that this is the age group that could face serious issues in the winter if hospitals become again overburdened. So I think that that's where it's going, and that's a message that the Greek Prime Minister, Mitsotakis, is trying to send.
Maria, she can do it all. A fantastic interview, and of course, reacting there to some breaking lines. Maria, thanks so much. That's our Maria Tadeo in Brussels. Now, coming up, Goldman Sachs seeks to combat burnout by boosting benefits for employees. But how do its new offers compare to that of other big banks? We're going to discuss that next. This is Bloomberg. Goldman Sachs is fighting burnout by boosting employee benefits. The additional perks include higher retirement contributions, paid leave for bereavement or miscarriages, and the option for a 6-week unpaid sabbatical for long-term employees. Joining us now to discuss is our bank's reporter in Frankfurt, Steve Ahrens. So, Steve, mentioned just some of the benefits there. Set the background for us. What more can you tell us on what Goldman is offering to its employees?
Right. So I think you gave a pretty comprehensive list of what they're actually offering. The really crucial part to see here is why are they doing this? If you remember, in the summer, Goldman Sachs was one of the first banks that came out and increased wages for junior analysts as a reaction to what happened earlier in the year when there was this, as you also may remember, this sort of presentation by a lot of junior staff that they were really unhappy in their jobs. So Goldman is really trying here to not just pay better, but also to show that it cares about the well-being of staff. And I think this is what they're trying to do here, really.
Well, how does it compare to some of the other big banks, both in the U.S. and Europe?
It seems to be a step ahead of the competition, if you will. And also in the summer, Goldman was the first one of the first banks, at least, to raise pay for junior analysts, and then took a second step when everyone else followed suit. Goldman then again increased the pay. So it's been a sort of a trendsetter here. It also was the company that was in the focus of all the criticism earlier this year. And now I think they really want to show they're ahead of the pack. And there is a chance that banks in the U.S. on Wall Street, but also in Europe, will follow suit when they realize that the war for talent, which is really, really hot right now, that Goldman is being successful in that pursuit and attracting talent, and they will have to follow suit.
Yeah, hard to say no to perhaps a six-week sabbatical. Steve, thanks so much. That's our banking reporter in Frankfurt, Steve Ahrens. Now, we continue to see markets sell off this morning. Really, the impetus for that seems to be headlines before 6 a.m. UK time of Moderna CEO concerns over the effectiveness of the vaccine on the new variant. Losses of more than 1%, more than 2% for travel and leisure. Well, Bloomberg Surveillance Early Edition continues in the next hour. Going to continue to look at this sell-off and what the new variant means for markets. This is Bloomberg.
This variant is a cause for concern, not a cause for panic.
I definitely think that this threat is something that we have not seen before.
Omicron definitely has the characteristics to create us concerned for many reasons. But also, we have been preparing for a moment like that for months.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Tuesday, November the 30th. Our top stories today. Moderna calls the Omicron variant a serious threat. The company warned that existing vaccines won't offer enough protection. The market responds. Stocks in Europe are dropping, so are U.S. equity futures. Bonds are rising as investors seek safe havens. And Jerome Powell and Janet Yellen head to Capitol Hill. They'll face questions about Omicron and the threat of inflation. Kailey, welcome everybody to the programme, of course, Bloomberg Surveillance Early Edition. And Kailey, front of mind really is the efficacy of vaccines. To what extent, to what percentage perhaps will they stand up to the Omicron variant versus what we've seen with the Delta variant? That really is what's going through the market's mind this morning.
Absolutely, Anna, and it may take us weeks to have those answers, but the market is reacting to the uncertainty right now. And we certainly saw that in the Asian session overnight. Decisively risk off. The MSCI Asia Pacific Index down about 0.6%, but China and Hong Kong both were lagging. And actually, the Hang Seng China Enterprises Index fell 1.5% and closed at its lowest since all the way back in May of 2016. At the same time, you're seeing equity sell-off. You are seeing that bid into safer haven assets, including the Japanese yen, which is stronger against the U.S. dollar by about 0.6%, sitting at 112.86. So 112 handle is back. And you're also seeing a bid into bonds really across the world. And that was true, too, in Australia, with the 10-year yield coming in about 5 basis points to 1.69%. Here in the U.S., it is a very similar story. Yes, we did see the buying of the dip coming in yesterday, but it's a dip once again on this Tuesday morning. Right now, S&P 500 futures are off a full percentage point. And you are seeing that similar move into bonds here when it comes to treasuries. The U.S. 10-year treasury yield now down 7 basis points, right around session lows, sitting at 1.42%. You're seeing oil taking it on the chin this morning because commodities really feel the variant, especially because of the demand outlook. WTI is down about 2.25%, sitting at 68.40. And Bitcoin trading in tandem with other risk assets. Risk off tone, not good for the cryptocurrency, Matt. Bitcoin down about 2.7%, trading at $56,700.
Yeah, you do see a lot of risk-off trading, a lot of safe haven seeking today. We also got inflation news that isn't going to make the market terribly happy, or maybe bad news is good news because it doesn't look like anyone's going to raise rates anytime soon if inflation stays like this. Yesterday in Germany, it was 6%. Today, Euro area inflation jumps to 4.9%, and the median estimate was only 4.5%. Now, I assume a lot of those estimates were taken before the German print or before the other European prints came out yesterday. Nonetheless, still ahead of estimates. Take a look at what's going on in Europe in terms of equities. We are down across the board. This looks like a dip buying opportunity for investors. 1.25% down on the DAX, 1.2% down on the CAC, 1.2% down on the FTSE. And if you look at what they're selling, well, they're selling every industry group on the Stock 600, but the biggest losers are travel and leisure stocks, energy stocks, as gas and oil prices come down. You can see here that autos are down, so cyclical's really taking a hit. Nonetheless, they're buying the pound. I mean, that is not the kind of risk asset that you want if you're freaking out. If you're panicking, you sell the pound. If you're panicking, you sell the euro and you buy the dollar, and the dollar is down today. So I think, Anna, that's really interesting. It doesn't seem like we know anything new today, right? Because we knew vaccines are less effective against new variants. We knew they're going to take 100 days, give or take, to create a vaccine that fights this one better. And we knew to take the mild infections with a grain of salt already on Sunday. But the market seems to be digesting some of it today and not all of it.
Yes, maybe it's the sort of definitive nature of, or the seemingly more definitive nature of some of the comments from the CEO of Moderna that's caught the market's imagination, taken maybe some people by surprise. But yes, the actual news flow not
markedly different from yesterday and over the weekend. And interesting to see what you say about the dollar not acting as a safe haven on today's risk-off session. Perhaps that has to do with Treasury yields. We'll get into that conversation in a little while. Let's just have a look at what's coming up today then. It's going to be a busy day ahead. Fed Chair Jerome Powell gets to defend his renomination when he appears before a Senate Banking Committee. That is a hearing taking place today alongside Treasury Secretary Janet Yellen, of course. The FDA's Antimicrobial Drugs Advisory Committee meets today. This is to discuss Merck and Ridgeback's request for an emergency use authorization for their COVID-19 pill. So all of this could take in Omicron, could take in the latest fight against COVID-19. So plenty to watch there. And of course, US data interpreted through the new lens of will we be heading into further lockdowns, including getting US data from the US consumer. So consumer confidence due at 10 a.m. New York time. So lots to look ahead to. And after dominating the top rungs of Bloomberg's COVID resilience ranking for months, Europe has largely been dethroned, with the United Arab Emirates, the UAE, becoming the new #1. Daily cases have stayed below 100 a day since mid-October in the UAE. Deaths are rare, and it's one of the most vaccinated places in the world. Colder weather, has ignited new COVID-19 waves across major Western economies, becoming a key differentiator of the best and worst places to be during the pandemic, just as a new variant emerges. We will keep you updated with that resilience ranking and how various parts of the world are performing. Now, Moderna's top executives say the world may need new vaccines to fight the coronavirus Omicron variant. The CEO, Stéphane Bancel, told the Financial Times it may take months for drug makers to develop and deploy updated vaccines. And Moderna's chairman, Noubar Afeyan, told Bloomberg the Omicron poses a serious threat.
I definitely think that this threat is something that we have not seen before. The number of variations, mutations on this virus are surprising. They're not theoretically impossible, but extremely rare. And so we have to take it for the serious threat that it poses.
Let's bring in Tim Lowe, Bloomberg European healthcare reporter, who joins us. And Tim, something spooked markets very early on. It did seem to be today this narrative from the CEO of Moderna, his perhaps slightly more definitive take on things. Some others in the sector saying, let's wait and see, let's test the vaccines against this new variant. But he seemed to be more definitive. Is it that weighs on risk assets, do you think? Is that a little bit new, or just a slightly newer nuance on that?
Sure. I think he definitely took it a step or two forward compared to what you've heard thus far from Pfizer and BioNTech and a lot of public health experts. Over the weekend and late last week, you were hearing a lot of, okay, we need to catch our breath, and it's going to take a couple weeks to study Omicron versus in the lab with the vaccines that we have. And everyone, calm down a little bit. In the interim, we can produce them fast, but we're not sure exactly how urgent that need will be. And then he comes out today, and he definitely brought it forward, made it sound like he's not so confident with the current shot's ability to do so.
All right, well, we'll wait for more answers and data on the vaccine efficacy against this variant. Thank you so much to Bloomberg's Tim Lowe. Now let's head over to Washington. Fed Chair Jerome Powell says the Omicron variant poses risks to both sides of the central bank's mandate to achieve stable prices and maximum employment. In prepared testimony ahead of a Senate appearance today, Powell says the virus could reduce people's willingness to work in person, slowing progress in the labor market and intensifying supply chain disruptions. Joe Matthew, Bloomberg Washington correspondent, joins us now from our D.C. bureau. So, Joe, that's Powell's opening statement. We know what he's going to say. Then it turns to the Q&A. What are lawmakers likely to press him and Janet Yellen on?
Well, boy, there's no shortage, and good morning. This was already getting outsized attention, I should say, in terms of testimony from Powell and Yellen following the renomination of Jay Powell, following the long conversation we've been having about inflation. And lawmakers do have a lot of questions about rising prices. You add this new variant, and this conversation gets a lot more complicated. Janet Yellen also issuing some remarks in advance, prepared testimony, suggesting that you cannot separate COVID from the economy. And that's what we're talking about about here. It's a job story. If you cannot solve the COVID issue, you cannot get people back to work and reach full employment. But Janet Yellen also pointing to the debt ceiling. This is going to be a big part of the conversation today. As you know, lawmakers have to address this issue by the end of the week. Not that we're going to default by the end of the week, but that's the deadline legislatively to handle the debt ceiling. Janet Yellen suggesting that if it is not handled in time here in the next several days and weeks, that it could eviscerate the word that she used, the economic recovery. So we have a lot of moving parts in this dual testimony today.
I want to ask about the SALT deduction cap. It looked like maybe we were making some headway, but now Bernie Sanders apparently has walked away. Of course, Sanders has been sort of the thorn in the side of those who want the SALT cap raised. What do we know?
Well, it's just a story that won't go away here, Matt. We're on the Senate side. Again, Bernie Sanders does not love the looks of an agreement that we thought had been struck here and wants to, instead of make this revenue neutral, actually pull some money out of the SALT deduction provision to pay for expanded Medicare. This has been back and forth between Bernie Sanders and Bob Menendez, Democrat from New Jersey here. The fact of the matter is, though, it's just a reminder. We could have another story like this in a week from now, that there is not a bill ready in the Senate and that they've got a long way to go. Senator Joe Manchin has also been speaking the last 24 hours, Matt, about his displeasure with the timeline, his increased worries about inflation, having heard about rising gas prices when he was home for Thanksgiving. So, no, there's no bill in the oven. It's not baked. It's not even ready to go in the kitchen yet, it looks like.
some more assembly of ingredients to do then. Joe, thank you very much. Bloomberg's Joe Matthew with the latest there from Washington. You can listen to Joe every weekday on his radio program, Sound On. That is at 5 p.m. Eastern Time on Bloomberg Radio. Now, Goldman Sachs added new employee benefits as part of a package of changes aimed at addressing worker burnout. Let's get more on this. Bloomberg's Stephen Aarons is with us. And Steve, good morning. Tell us more about what Goldman is going to be offering then to its employees.
Hey, good morning. So Goldman is actually, you would expect the typical response to this kind of displeasure in the staff is raising wages, raising pay. But this is different. They're offering better leave conditions. So if a close relative, for example, passes, you get better leave, you get better maternity leave, or when there's a miscarriage. So I think it's a new approach to showing that people, that Goldman cares about the well-being of staff. And as you may remember, this comes after a controversy earlier this year where a lot of junior staff at Goldman protested the working conditions they saw as too harsh and too much of a workload. So I guess this is really a step to show we're taking this seriously and we're doing something about your well-being. We're not just raising pay, we're actually offering you better working conditions.
Yeah, it'll be interesting to see if we start seeing benefit wars, not just salary wars. Thank you so much for joining us, Bloomberg's Stephen Aarons. Now let's get back to the U.S. equity markets and take a look at some stocks moving in pre-market trading. And no surprise, given the fact that it is the Omicron variant fears dominating the market narrative this morning, you are seeing the usual COVID-19 sensitive sectors under pressure in early hours, including the travel complex. And one example of that is Norwegian Cruise Lines. It's down 3% in pre-market trading and already is trading around its lowest level in a year. So more losses could be coming come the opening bell. You also are seeing a gain for some of those stay-at-home winners. Again, this is your classic COVID-19 trade. The likes of Zoom Video getting a little bit of a bid in pre-market trading, up the better part of 2%. And another stock higher on all of this news is Novavax. Of course, it has a COVID-19 vaccine candidate in the works, and the European Medicines Agency says it could have approval in the coming weeks. So that stock is getting a nice lift before the bell, Anna. It's up about 3.5%.
Yeah, more broadly, interesting to see that we've got actually vaccine makers pretty mixed in the pre-market over in the US. So we'll see how the latest comments from the CEO of Moderna impact that sector. Coming up, risks for the Fed. We'll preview Jerome Powell's prepared remarks ahead of today's Senate appearance. And markets shaken by vaccine worries. Susannah Streeter of Hargreaves Lansdown joins us with her take later. Plus, when will the bottlenecks end? We will talk to the HSBC trade economist on this program. That conversation around supply chains will be up shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Anna Edwards in London and Kailey Leinz in New York. Now, Jerome Powell is issuing a warning over the new Omicron variant. In prepared remarks ahead of today's Senate appearance, the Fed chair said rising cases and the variant's emergence pose downside risks to employment and economic activity and increased uncertainty for inflation. Lynn Thomason, Bloomberg managing editor for EMEA Markets, joins us now. And Lynn, it does look like we're pretty certain about inflation. It's here, and it seems like it's going to stay for a little while.
Yeah, definitely. But I guess the question is, what will Omicron do for that? I mean, how does that change the picture? Does that mean that the Fed will be, softer on tapering? Will we get monetary stimulus for longer?
Lynn, good morning. And help us understand the way that the market is reacting to all of these questions as you set them out. In particular, the flight into haven assets, which at other times you might have included the dollar in that list. But both on Friday and today, we've seen the dollar falling. So the dollar not providing that, not playing that role as a haven. Is that to do with falling treasury yields and positioning in dollar markets? Is that what's going on here? Because it does seem, Matt and I were talking earlier, it does seem a little unlikely that the euro and the pound gain in a risk-off environment.
Yeah, that's a really interesting observation. I mean, I think overall what you're seeing is markets being risk-off. From gold, whether it's tech stocks, small caps, everything is kind of falling across the board. So, I think the dollar would be sort of the one weird part of that equation.
I will say, and Kailey, you may have seen this as well, we had a viewer write in saying that in terms of the pound, at least, maybe there's some closing of shorts going on here. So it could be technical issues. Remember, yesterday we saw the dollar up even as we saw a risk rally. So maybe there's a little bit of technical issues in terms of the FX trade.
Yeah, the FX behavior has been really interesting to watch over the past several days. And Lynn, I want to bring it back to you because you said pretty much everything is selling off. The one thing that's not right now is bonds. You actually are seeing that safe haven bid, and the 60-40 is working. Can that continue?
Yeah, that's a really interesting idea. I mean, I think clearly it's working now, and if treasuries keep going up, investors will get that safe haven, that hedge that they so desperately need from the rest of the market. I think there's been a lot of questions. Does 60-40 still work with bond yields at this level? But it's working today, and other investors will say, we're looking at volatility assets, play the VIX as a way to get protection against these stock market losses, but good old-fashioned bonds are doing the trick.
Yeah, well, I was reading yesterday in Matt Winkler's column, Gary Schilling says that bonds are going to continue to rally. It's been a 41-year bull run for bonds, and Schilling says he sees 1% by year end. Is that a contrarian view, or is he in the consensus right now?
It certainly seems a contrarian view. I mean, it seems like, the people calling the end of the bond bull run have been many, and it hasn't turned out that way yet, and certainly not today. But I think, even sort of in the longer term, I think you'll still, with bond yields at this level, you're still going to have the question of how much more can it go?
Another asset that's really responding to this risk-off tone then, Lynn, is oil prices, down another 2.9%, 71.29 on the Brent price here in London. And, I mean, we've got an OPEC meeting coming up later on this week, and if we continue to see weakness and nervousness around the price, that's going to add another dimension to that meeting, where people were already wondering, is OPEC Plus going to change its plans for the future?
Yeah, absolutely. And you're clearly seeing oil prices being depressed, and that's feeding through to part of the sort of the travel and leisure stocks being hit as well. I think anything to do with transportations are clearly the first things to fall when you see these border closings happen.
Yeah, jumping out of the COVID playbook. Lynn, thank you very much. Bloomberg's Lynn Thomason with the latest on these market moves. For more market analysis, you can check out MLIV Go on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Anna Edwards in London and Matt Miller in Berlin. Now let's get the first word news. And in China, manufacturing rebounded in November after a power crunch subsided and price pressures eased. The Manufacturing Purchasers Managers Index rose to a level that signals expansion in production. That's the first time that's happened in 3 months. Democratic Senator Joe Manchin won't commit yet to moving ahead on President Biden's tax and spending bill before the end of the year. Democrats need Manchin's vote to go forward, and he's still reviewing a version of the legislation passed by the House. He says he's concerned about the impact of more federal spending on, you guessed it, inflation. Tiger Woods is admitting that his days as a full-time pro golfer are over. Woods suffered severe leg injuries in a car crash last February, and in an interview with Golf Digest, Woods said he could see himself playing in occasional tournaments, but he wouldn't return to the tour on a regular basis. Woods has won 82 tournaments in his 25-year career. And there's another indication that Americans did their holiday shopping earlier because of concerns about global shipping logjams. Cyber Monday sales were flat compared with a year ago. Inventory was scarce, and there weren't many deals on big-ticket items such as electronics. Big sale days like Black Friday and Cyber Monday have been gradually losing their prominence. And Matt, it may not have just been a case about people shopping early because of supply chain issues. You also saw the deals for Black Friday and Cyber Monday starting way earlier this year as well.
Yeah, they start earlier, they last longer. It's much more of a global shopping season than it is an American issue now. And, you know, for me personally, one of the big benefits of living abroad is I don't buy anyone Christmas presents. So,
Scrooge.
Matt, that is terrible. What an awful admission. What an awful admission. I just feel like since March 2020, literally every Monday has been a Cyber Monday. It's one big cyber life,
good
really,
point.
isn't
That's
it?
a very good point.
Maybe we don't look forward to the whole Cyber Monday quite so much as we might have done earlier. Right, coming up on the programme, Susannah Streeter, Hargreaves Lansdown Senior Investments and Markets Analyst, will be with us. We'll talk to her about the risk-off moves we're seeing in these markets, the risk aversion, the flight into safety. It's not including the dollar. Is that all about treasuries? Is it about positioning? We'll get her view on where we go on currency markets. Also equities, the travel and leisure stock under pressure once again. The threat of further lockdown, really the last thing that sector has on its mind. We'll talk about all those themes next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in Berlin and Kailey Leinz in New York. And Matt, we've been talking all morning about the risk-off moves that we're seeing in markets as a result of maybe the restatement or slight intensification of nervousness from CEOs of vaccine makers, in particular Moderna, around the way that vaccines are going to stand up to Omicron. But hot off the presses, I mean, this is all about the market moves here, and hot off the presses from a Markets Live team, they're talking about how actually the flight into treasuries is really intensifying this morning. And ahead of the US session, Matt, that's probably worth bearing in mind. The flight to safety into treasuries becoming more pronounced now with moves in the 7 and the 10-year maturities really taking effect. It's something we should certainly be keeping an eye on because, of course, of the connection with the dollar as well.
Well, and maybe because of inflation. You know, we saw European inflation come across at 4.9%. The estimate had been, the expectation in a sense had been 4.5%, and the prior number was 4.1%. So inflation here is strong just as it is there and in the U.S. And when we keep getting these inflation numbers, that means the market can push back expectations for a rate increase. And if they don't expect rates to increase anytime soon or even later than they previously did, then they can go ahead and buy bonds now. So that could be another reason we're seeing that, since you don't see a flight to safety in the dollar. Now, I was talking earlier about a viewer who wrote in, and he is, or she is, I'm not sure who the viewer was, saying that, you know, a lot of covering is going on in short positions, which is leading to strength in the pound. But we also see strength in the euro, which doesn't make a lot of sense if there's a little safe haven seeking going on. So there are some interesting moves in these markets, to be sure.
Absolutely, and it just looks like Friday, doesn't it, Kailey, on that front? Certainly the dollar selling off and the euro gaining. It seems like the Friday trade really stood out in a sea of other very sensible risk-off moves.
Yeah, it's a decisively risk-off tone, just like Friday was. The moves aren't quite as dramatic as we saw on Friday, but the session is still young, so we'll have to wait and see. Right now, it is definitely decisively risk-off when it comes to equity markets. The SOX 600 in Europe down right now about 1.25%. Every single sector is in the red. The biggest losers sectors are energy and travel and leisure. Maybe no surprise given that it is COVID-19 fear that is dominating the market narrative today. And you are seeing futures lower with about 4 hours to go until the U.S. Open. Right now, S&P E-minis down a full percentage point. Anna, you were talking about that massive bid into treasuries. The U.S. 10-year yield is down 7 basis points. We're south of 143. We're sitting at 142.56, so a big move in yields. And you also are seeing the commodity complex under pressure. Oil has been especially sensitive to each and every headline because the demand outlook is so closely tied to the trajectory of the virus. Right now, Brent crude is off the better part of 3%, trading at $71.30 a barrel. No surprise then, energy players are among the big underperformers in U.S. pre-market trading. Apache down 2.2%, Occidental Petroleum down 3.5%, and pretty much everything in travel is also lower. Marriott Hotels down 2.5%, and American Airlines the better part of 4%, Matt.
You know, I'll show you something that's definitely decisively risk off here as well, Kailey. We've got a chart, and I'll walk our radio listeners through this as well, that shows stocks that are in the the Barclays EY, Ernst & Young vaccine beneficiaries. You know, they rose at the beginning of the pandemic. As we realized that the vaccine was coming out and could do something against this virus, stocks like Deutsche Lufthansa or Ryanair and EasyJet, airport operators, airplane engine builders, they rose. But as these vaccines have lost efficacy against variants like the Delta variant, it came down. Now they're coming down even further. This big drop is the Friday where I was watching you and Anna comfortably from home, full of turkey. And we're seeing another little drop here at the end. So vaccine beneficiaries, those stocks that gain when we get good news about vaccines, are down today because of the concern about the effectiveness of those vaccines. Joining us now is Susannah Streeter, Senior Investment and Markets Analyst at Hargreaves, Lansdown. And Susannah, I wonder what you make of the Omicron variant. That's what everyone's been talking about for the past 3 trading sessions, and it doesn't seem that these concerns have gone away.
Certainly doesn't, and I think it really does show that the roller coaster ride has resumed on the financial markets. And what you saw yesterday was more like a break run between a double dip of losses, because there had been some expectation that perhaps the news coming out of South Africa that the infections weren't necessarily more severe. Well, that's faded now after the World Health Organization, and also these comments from Moderna's boss have come out indicating that perhaps vaccines won't be so effective. So yes, as you say, in the trades we're seeing in pre-market trading in the US, it's replicated in trading since trading began here in London. So the FTSE 100 down around 1.25. And that is really travel stocks, those reopening stocks, perhaps some of the ones listed on the Barclays EY index that you were talking about. We've got the likes of Cineworld, for example, down at 2.5%, but mainly it's the airline stocks again. Now, there had been a bit of a recovery on the open, it appeared, after EasyJet came out with some results which weren't quite so bad as expected, and actually said that they still thought recovery for summer 2022 was on track. But actually, those slight gains have disappeared, with the likes of British Airways owner IAG plunging again down by around 3%. Yes.
Susannah, what are you looking for then when it comes to the travel and leisure sector? I spoke to the CEO of EasyJet earlier on. He was saying, yes, there is evidence in their bookings over the last few days of a response from consumers around Omicron, but it's more about delaying bookings at the moment rather than cancelling them. I suppose the sector will be hoping that that continues to be the case and just holds out for a couple of weeks while we get more data.
That is, I think, the case. But the problem is so many travellers have become weary of booking, then rebooking, then possibly losing the money that they had on hold because they can't find a suitable date. And the worry is that actually they may try and rebook, but they're probably likely to push those booking timings further into the summer, and you're not going to get the spring early summer bounce that actually investors really had hoped for and looked like to be on the cards before this new variant really reared its head. And I think that is the real concern. And that's why you've seen the likes of Intercontinental Hotel Group fall lower today. Whitbread, the owner of the Premier Inn chain, also lower again, because it's those bookings as well, domestic bookings, that could suffer. Now, intercontinental hotel groups had benefited from a surge in domestic bookings, particularly in the United States. But the worry is actually that people will become a lot more cautious in the short to medium term.
Susannah, taking kind of a wider angle on this, JP Morgan strategist publishing this morning said COVID actually isn't the big risk to 2022. It's the normalization of monetary policy. Do you agree with that?
Well, absolutely, because it's a difficult situation, isn't it, that we're currently in? Because as soon as we get news of fresh concerns about a new variant, that affects the stock market. But then there's this other push the other way, because it actually could mean that we'll hold off with this tightening for longer, because of course the markets have been really become hooked on this drug of cheap money. And it's all to do, of course, with the amount of money washing around. If there is more money for investors to put to good use, to invest into the stock market, it will certainly mean those prices will be sustained. The problem that we've got is that people do have more money at the moment. They've still got this pandemic savings that are reasonably high, and they want to spend it, but they can't spend it on services because of all of these supply chain issues, the labour issues in particular there. If you try and get a builder anywhere at the moment, it is highly difficult. You can't spend it on services, it's being spent on goods, and that's driving up the prices, and that is where the central banks are going to have to look at, because that's pushing up inflation. And I think the money being funneled into goods in particular rather than services is what will lead to more of a tightening further down the line.
Susannah, when you look at the possibility of renewed lockdowns, I'm concerned about that here in Berlin. A, do you think that's going to happen? B, do you think that European countries, maybe even the European Union, are going to need new cash injections?
Well, that is the clear worry. And I think that's why you've seen stock markets in Europe hit more than in Asia, because, of course, as you well know, there are lockdowns in place, many regional lockdowns in parts of Europe, and curfews in particular, and that's already hurting. And certainly, if there is a fifth wave of COVID, that really could hurt. And yes, there will have to be more cash injections to keep certain sectors, particularly hospitality, alive. I mean, the furlough schemes, the job retention schemes have been rolled back, but they may have to be rolled out again if there is a mass blanket ban on these the restaurants, bars and pubs opening. And so, yes, there is likely to have to be further support if this is the case. But look, we're in a wait and see mode at the moment. We really don't know as scientists scramble to establish just how effective they are. And I think as well, it's all going to hinge on whether these boosters can be rolled out faster, because the indications are they will still offer some protection. And so the fight and the race will still be on in those countries to make sure the unvaccinated get vaccinated.
Susannah, thank you very much for joining us. Susannah Streeter of Hargreaves Lansdown with her perspectives on the markets. Coming up on this programme, when will the supply bottlenecks end? We will talk about trade. In fact, we'll talk to the trade economist who'll be joining us next from HSBC. That is Shanella Rajanigan, who'll be with us shortly. This is Bloomberg.
Although in the first 2 or 3 months there was a lot of chaos, it was the biggest thing that ever happened for 102 years. But here we are with trade being 5% higher than pre-pandemic levels and supply chains actually working pretty well. There's been some traffic jams, there's been some congestion, but people, from an express point of view and an air freight forwarding point of view, are getting what they need pretty much when they need it.
That was John Pearson, DHL Express CEO, speaking to us earlier today on global supply chains. And joining us now to talk more about that is Shanella Rajanigan, HSBC trade economist. So, Shanella, great to have you. When we look at the Omicron variant, we've seen in the past that one case at a port in China could shut it down and wreak havoc on global shipping lanes. Do you see a situation where that could happen again?
Yeah, absolutely. I mean, that is one of the key risks with the current supply chain crisis at the moment. It's that we have these existing bottlenecks, existing congestion at ports, and at the same time, a very low tolerance for COVID-19 cases at certain key ports and in certain countries around the world. So yes, the potential for unforeseen factory closures or indeed even port terminal closures does remain a very key risk looking out into the near term.
Good morning, Chanel. Yes, I was just looking for one example of this, just popping up on the Bloomberg. One company over in Malaysia that does palm oil and other agricultural products saying any new lockdown will delay arrival of plantation workers. And it's that kind of experience repeated in many parts of the world that might add to our concerns around supply chains. As we think about a new variant, which part of the world will you be focused on? Will you be focused on Asia and a propensity to lock down, and that will be your focus, Chanella?
Yeah, I mean, the focus really is global, but it is what's important for key trade routes. And as we've seen, that channel from Asia through to the west coast of North America and also from Asia through to North Europe is very key for trade. And it's really been where the support for global trade volumes has come from over the past 20 months or so. So any further disruption in Asia, any potential factory or port closures could certainly affect the flow of goods from east to west.
I know that, before there was Omicron, there was Delta, and there were plenty of others, as we very well know, Chanella. And you've been looking at how bottlenecks have been talked about by CEOs, I know, through the last earnings season. What have you seen when you've used technology to look at the language being used by CEOs? What sense do you get as to how far through this we are, if we put to one side Omicron for a moment, which I know is difficult to do?
Yeah, so along with our data science team, we have been using NLP techniques to analyze some of these earnings calls. And as of no surprise to anyone, really, supply shortages were of a key concern for CEOs around the world. But this was particularly pronounced for companies in the technology and industrials and in the consumer goods sectors. And then in addition to that, management in US and European companies were particularly concerned about shipping disruptions as well. And so they spoke a little bit about the types of strategies they've taken to mitigate some of these supply chain disruptions. But in terms of a timeline for when this might end, it is all up in the air at the moment. So it could be anywhere from over the course of next year through to 2023.
Yeah, I'm wondering the same thing. You know, I'm looking for, I want to buy a new GMC Yukon. I want the AT4. It's kind of the off-road version with the 6.2-liter V8. It's just available in 2022. But all the dealer lots are empty, and anyone that has one of these trucks is charging at least $6,000 over sticker, more like 10 to 15, some even 25, and they don't expect to get real inventory for 12 to 18 months. Does that sound like a reasonable time window for you?
Yeah, I mean, the thing is these supply bottlenecks and the inventory shortages do really vary by sector. And so this is one of the other key risks looking out ahead, because even though if trade disruptions do start to ease at some point, we have pent-up demand for the shortages in these certain sectors, and autos and vehicles are a key one. So that pent-up demand could come back at different times. And so it means that trade disruptions won't necessarily fully ease until all these disruptions have started to abate.
Chanella, thank you very much. Thanks for joining us. Chanella Rajanayagam, HSBC trade economist, with the latest on trade disruptions. We were so close to getting through it, perhaps, and now we have to think about where Omicron takes us. Coming up on this program, though, where will Alphabet's next $1 trillion come from? Part of our interview with the CEO, Sundar Pichai. That's next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in Berlin and Kailey Leinz in New York. On the latest episode of Bloomberg Studio 1.0, Emily Chang sat down with Alphabet CEO Sundar Pichai to talk about where the company's next trillion could come from.
Google just hit a $2 trillion market cap. Alphabet, I should say. Where is the next $1 trillion going to come from?
You know, I've always felt, your market cap valuation is an effect of the value you provide. And I feel fortunate our mission is timeless. There is more need to organize information than ever before. I still feel search is our biggest moonshot as a company. People will want radically more conversational experiences. They will want what we call multimodal experiences. They may speak to search. They may look at something and ask what the information is. Being able to adapt to all that and evolve search will continue to be the biggest opportunity. We are so excited about, be it YouTube, cloud, our hardware products, Google Play. So we're building a diverse set of businesses, and underlying all of it is the investments we are making in AI. We've invested $100 billion in R&D in the past 5 years. And so applying AI in a deep way is probably where we will create the biggest opportunity ahead.
That was Alphabet CEO Sundar Pichai talking with Emily Chang about AI, about Google. We have Tom Keene with us, co-anchor of Bloomberg Surveillance, now to preview what he's got in this program. I just want to point out, Tom, I read a great anecdote yesterday about Google technology. They're working together with General Motors, and a reviewer of, I think, a new Denali or something, asked the car, "Hey Google, how much gas is left in the tank?" And the car said 61%, and it was spot on. So the things that you can do with this are just pretty amazing.
I really wish I had that technology on a cold Tuesday evening in the Adirondacks 43 years ago, where I walked 7 miles to get a gallon of gas. Let's talk about the markets. How about that? Futures -50, Dow futures -472. The VIX goes out 4. Let's look at the thermometer of the market. Where are we in the last 6 tumultuous days? And Anna, it's just real simple. It's really historic, the volatility we see. We're buttressed right up against where we were 2 days ago. But it's just simply a good indicator for people waking up in America saying, where are we right now? Where we are is we've gone back to the tension of a few days ago, but we really haven't broken through.
Yeah, we're a bit fearful once again, aren't we, Tom? Based on these latest lines from the CEO of Moderna and his seeming, well, not conviction around them, but he seems a little more certain than maybe some of the other comments we've seen. This move on the VIX, though, is interesting because it seems as if we have pulled back on that gap between equity market volatility and rates volatility. It's all been about rates volatility earlier on.
Yeah, I totally take your point. I think there's a new correlation there that wasn't there 2 days ago. There was a separateness 2 days ago. We're watching a 10-year yield. I'll mention this with John and Lisa here in a moment, but the 10-year yield has gone 4 standard deviations, +2 to -2, -2 to +2, et cetera, 3 times in the last X number of days. I don't believe I've ever seen that, Anna.
It's very interesting. I note, and you can talk about this with John as well, the Dow Jones Industrial Average lost more than 900 points on Friday, and it only made back 236 yesterday. So there's a lot more buying of this dip that can happen. Tom Keene there, co-anchor of Bloomberg Surveillance. Thanks for joining us. I want to take a look at what else we're watching. And for me, it's all about the pronunciation of Omicron or OMICRON or OMICRON. I don't know whether Homer or Pythagoras would have said OMICRON or Omicron, but I know that the accent would have been on the second syllable, Anna, because the point of this 15th letter of the alphabet, it's O minor. It's the small o as opposed to omega. So it should be Omicron and not Omicron.
If you want to obsess about the pronunciation of it, you go ahead, Matt. I'm just glad it's not new or knee or whatever that would have been, because that would have got very confusing. We'll focus on Omicron, whatever you want to call it. We'll also focus on Powell and Yellen. Of course, they're going to be in front of the Senate Banking Committee, 10 a.m. Eastern time. That takes place. And it's important because we heard from Powell overnight, and before the markets were scared by the latest lines around the vaccines and the virus, they were comforted by what Powell had to say. So I wonder if that's something we need to watch out for later on, the way that he was talking about how their twin goals could be, to some extent, affected by the new variants. That did seem to calm markets. It led to a bit of a risk-on trade overnight into the Asia session. So we'll see how that develops. Plenty more coverage, of course, of that testimony. More Bloomberg Surveillance is ahead. We'll hear from Howard Ward of Gabelli Funds and plenty more. This is Bloomberg.